Financial ruin usually happens through dozens of small, quiet mistakes that feel perfectly normal at the time. These tiny decisions pile up day after day, slowly hollowing out your account without ever triggering an alarm. A streaming subscription you forgot to cancel 6 months ago continues to draw funds from your balance every 30 days. A monthly car payment that sits just slightly above a safe budget threshold quietly strains your flexibility. This graph illustrates the compounding danger of credit card debt. While the minimum payment remains flat, the exponential line shows how quickly a balance grows when interest outpaces contributions. These leaks operate silently, siphoning wealth while you focus elsewhere. Eventually, you check your account and realize you are significantly behind, feeling like you have been hit by an overwhelming, unexpected force. Going broke is a slow, unnoticeable erosion of resources, the result of normalized habits that eventually hollow out your safety net. People who avoid this financial spiral manage their money without necessarily earning larger paychecks or possessing superior math skills. For years, Alex earned a decent salary, but had absolutely nothing to show for it at the end of every month. He tried managing the money manually, rotating through various budgeting applications and complex tracking spreadsheets, but the results never lasted. Manual methods like these fail because they rely on constant human willpower. They require an exhausting internal negotiation that eventually collapses under the pressure of daily life. True financial stability requires a system that removes emotion and daily decision-making from the equation entirely. Stability comes from 7 background rules that handle the hard decisions for you automatically. Rule 1 serves as the foundation for everything else. You pay yourself first. This flowchart shows the mechanics of Rule 1. The moment your paycheck hits the account, a fixed amount is instantly diverted into a locked savings node before the remainder ever reaches your spending node. This routing happens automatically, ensuring savings are secured before you spend a single dollar on bills or discretionary items. This system replaces the flawed strategy of trying to save whatever is left over at the end of the month. Prioritizing your savings at the precise moment of deposit changes your entire financial trajectory for the month. Just as fluid expands to fill its container, your personal spending naturally expands to consume whatever funds are visible. Moving the money first creates an artificial boundary, forcing subconscious spending adjustments based on a lower visible balance. You find yourself naturally skipping minor daily purchases without feeling like you're actively sacrificing your lifestyle. You can achieve a quick win today by opening your bank app and setting up an automatic transfer to a separate savings account. Establishing the consistent habit is more important than the specific amount, even if you start with only $25 or $50 per paycheck. This automation treats your future self as a non-negotiable bill that must be paid before any other expense. This single automated habit forms the unbreakable baseline required to support the remaining 6 rules. Automated systems create the dividing line between wealth builders and those who spiral, making it harder to fail than to succeed. Here is something most people never consider about financial advice. It rarely fails because the math is wrong. It fails because it assumes you will make the right decision every single time. Every purchase, every paycheck, every temptation. Nobody actually does that. Relying on sheer willpower to navigate a modern economy is exhausting, and eventually human motivation cracks. That is why rules succeed where motivation drops off. A rule is simply a decision you have already made in advance. You do not have to wake up and debate your spending every morning. You set the parameter once and you follow it. Replacing daily motivation with rigid, automated rules is the first step in constructing a durable financial defense. Rule 2. Build an emergency cushion before you attempt any advanced investing. Before you open a brokerage account, you need cash set aside for things you cannot predict. A sudden medical bill, a transmission failure, or an unexpected layoff are not matters of bad luck. They are mathematical certainties. It is a matter of when, not if. If you do not have cash sitting ready for those moments, your portfolio is exposed. One bad month can force you to liquidate investments at a loss and erase years of saving. You cannot safely grow wealth until you construct a barrier against immediate, unpredictable threats. The target for this cushion is highly specific. 3 months of your basic living expenses. Not your full lifestyle, just the absolute essentials: rent, food, utilities, and transportation. If your essential basics run $2,000 a month, your initial target is $6,000. Keep this money in a high-yield savings account. It earns interest while keeping your cash entirely liquid, isolated from the daily swings of the stock market. You do not need to fund this entirely overnight. Add to it systematically alongside your automatic savings each month. The goal is to build it before something goes wrong. This specific account has exactly one job. It is not there to generate massive returns. It acts as a mathematical shock absorber to protect everything else you are building. Rule 3. Eliminate high-interest debt before it quietly eats your progress. If you carry credit card balances or other expensive debt, you are fighting a mathematical headwind. Interest charges add to your principal month after month, making the hole deeper while you are actively trying to climb out. This diagram of a bathtub shows what happens when you try to invest while carrying expensive debt. It is exactly like filling a tub with the drain wide open. Money goes in, but an equal or greater amount leaks right back out. You might feel like you are moving forward by putting cash into the market, but the math of your interest rates is secretly eroding your net worth. Plugging that structural leak of interest is a mathematically mandatory step. You have to close the drain before you can actually fill the tub. Once your safety net is secure, funnel all extra cash strictly toward the single debt with the highest interest rate. Pay only the absolute minimums on everything else. Keep hitting that highest interest balance until it is entirely eradicated. This process is not about guilt or shame. Picking up debt is a completely normal occurrence in the modern financial system. The point of this execution is not moral judgment. It is purely about stopping a mathematical drain so the rest of your financial plan can actually function. Paying yourself first, building a cash safety net, clearing out expensive debt. If you execute just these 3 actions successfully, you will place yourself in a much stronger financial position than the vast majority of people around you. But the system is incomplete. There are 4 rules left to master, and the next 2 are the ones people inadvertently break the most often, usually without even realizing it. True financial resilience requires sealing this bedrock foundation perfectly before you attempt to build anything upward. You are paying yourself first. You are building that emergency cushion. You are systematically chipping away at expensive debt. If you have that foundation in place, you are already miles ahead of the vast majority of the population. But to keep that momentum, the next phase of building wealth is not about starting a new habit. It is about identifying and stopping the behaviors that quietly pull you backward. When your progress is slowly being erased, it rarely feels like a mistake. Often, it feels exactly like success, right up until the moment you realize your net worth is completely stuck. Which brings us to Rule 4. Do not let your lifestyle grow as fast as your income. Here is the standard trajectory when things go right. You land a promotion, secure a better paying job, or negotiate a solid raise. Suddenly, you have more cash flowing in. You lease a nicer apartment. You finance a newer car. You pay for more dinners. This chart compares 2 time periods. In period A, you have your baseline income and a modest green block representing savings. In period B, your income goes up, but that new vertical space is instantly consumed by a red lifestyle block. The total monthly amount routed to savings remains exactly the same. Behavioral economists call this pattern lifestyle creep. It's the primary reason individuals earning high incomes find themselves trapped in a rigid paycheck-to-paycheck cycle. The trap works perfectly because upgrading your environment feels like the natural, justified reward for your hard work. You feel wealthier, blinding you to the fact that your actual wealth is entirely stagnant. To break this cycle, you have to follow a strict mathematical sequence. When your income goes up, your savings rate must be adjusted upward before you permit a single change to your lifestyle. Say you earn a raise that adds $500 a month to your take-home pay. This teal block represents your new $500 raise. Allocate half of that increase, roughly $250, routes directly into savings. The remaining $250 goes entirely to you for lifestyle upgrades, completely free of guilt or restriction. Splitting the difference forces you off the faster treadmill. You are still enjoying the extra money, but you are no longer burning through every new dollar just to maintain a more expensive baseline existence. Applying this specific 50-50 ratio guarantees that every single pay bump mathematically increases your absolute wealth. Now we move to Rule 5. Stop leaving big risks uncovered. Insurance naturally creates psychological friction. You are handing over cash every month for a product you actively hope to never utilize. Because of that friction, people frequently skip coverage altogether, or they blindly select the absolute cheapest legal option without ever checking their liability limits. We are not talking about the minor inconveniences of daily life. We are talking about rare, catastrophic events with the sheer scale to erase 10 years of careful saving in a single 24-hour period. This diagram illustrates what a catastrophic financial hit looks like. A major medical emergency, an at-fault car crash lacking adequate liability coverage, or fire destroying an uninsured apartment can cause a massive savings balance to be instantly dropped to zero. Proper financial defense does not mean eliminating every daily risk. It means systematically transferring the specific risks capable of causing total financial ruin. The actionable baseline requires a few specific steps. Secure health insurance against medical debt, verify high enough auto liability limits, obtain a basic renter's policy, and add simple term life insurance if anyone depends on your income. Term life provides a set financial payout to your beneficiaries if you pass away during a specific limited time period. But securing those policies introduces a secondary behavioral blind spot. Most people set up their coverage once and then never look at it again. As your life evolves, your variables shift. Your income increases, your marital status changes, or you welcome a new dependent. When these changes happen, your old coverage limits are rendered obsolete. This graphic tracks an individual's assets over 10 years. A liability shield perfectly covering a single asset at age 25 remains the exact same size at age 35. It completely fails to cover the newly added assets, leaving a glaring, highly vulnerable red gap. The simple maintenance solution is to commit to a brief once-a-year review of all your active policies to identify and close any newly formed gaps. Wealth preservation requires continuous calibration. If you rely on static defenses, they will eventually fail against the realities of a dynamic, evolving life. When people skip these two rules, they allow devastating setbacks to bypass their foundation. The damage comes either through the slow drip of unchecked spending or the sudden shock of an unprotected catastrophe. But when you strictly cap your lifestyle creep mathematically and actively transfer your catastrophic risks, the defensive perimeter around your money is complete. With these first 5 rules functioning together as a sealed system, the wealth you build is securely protected from unraveling. Establishing this flawless defense is the mandatory prerequisite. Once the floor is secure, you are ready to move to the final 2 rules, where the focus shifts entirely to aggressive, long-term wealth expansion. 5 rules are now locked into place. You have secured your starting position. Your safety net is building, expensive debt has been cleared, and your lifestyle is not outrunning your income. By covering your major risks, you have built a wall around your financial life. With the base secured, the next objective is growth. It is time to put your money to work. This defensive perimeter is exactly what makes long-term wealth building possible. Because your downside is protected, you can commit to the market without the fear that a single emergency will force you to liquidate your future. This leads to Rule 6. Invest consistently instead of waiting for the perfect market moment. Many people freeze here. They see a rough headline or a volatile week on the indices and decide to wait until things calm down. But the market rarely feels calm. There is always a looming economic report or a geopolitical event to worry about. If you wait for the perfect moment, you are waiting for a mirage. The cost of this hesitation is steep. While you wait for clarity, time passes. Your money sits idle, losing the opportunity to compound and grow. Inaction is often framed as caution, but it is actually a guaranteed way to fall behind. The longer your money stays on the sidelines, the harder it has to work later to catch up. This diagram shows the difference between 2 common strategies. One side attempts to time the market's swings. The other shows an investor contributing a fixed amount on a regular schedule, month after month, regardless of the noise. By deploying capital on a strict schedule, you bypass the need to be right about the direction of the economy. You end up buying through the peaks and the valleys, ensuring your capital is always working. This strategy is not about chasing the glamour of a hot stock. It is a mathematical approach that prioritizes volume and time over precision. This diagram shows the mechanics of a broad market index fund. An index fund is a single investment that spreads your money across many different companies at once. This diversification means your wealth is tied to the growth of the overall market rather than the survival of a single company. To make this work, you link your bank account to a brokerage or retirement account. This creates a mechanical loop where your contributions happen automatically every month without requiring a new decision. When you automate the process, you remove emotion and friction. Consistency becomes a system rather than a test of willpower. There is a necessary nuance here. Investing always involves risk. There will be years where the market drops and your portfolio balance shrinks. This strategy is not a short-term wealth guarantee. However, decades of historical data show that for those who stay consistent through these cycles, the market has been one of the most effective tools available for building meaningful net worth. You protect yourself by separating your timelines. Money you might need in the next few years stays in a savings account. Only long-term capital, money you won't touch for years, goes to work in the market. Defining these timelines creates a psychological buffer. You can watch a market downturn without panicking because you know that specific money isn't needed for your rent or groceries next month. All of these systems require a checkup. That is Rule 7. Know your numbers and check them every single month. This diagram shows the 4 metrics for your monthly check. You spend 15 minutes reviewing what came in, what went out, your total debt, and your total investment balance. Many people operate on fuzzy feelings rather than hard data. When the details are unclear, money tends to leak through subscription creep or unmonitored spending. This brief review catches those leaks early. It shows you exactly where your savings have stalled or where an expense category has drifted, allowing you to course correct before the damage compounds. Rule 7 acts as the diagnostic tool for your entire system. It is the structural glue that ensures the first 6 rules are actually being followed. Let's turn these rules into a checklist for your week. First, open your investment account. Second, pick a broad fund and set a small, recurring investment that you can stick with regardless of the market's mood. Third, put a 15-minute block on your calendar for the same day each month. During that time, record your 4 diagnostic numbers so you can see your trajectory. These 7 pillars work because they don't demand constant effort. They rely on turning financial principles into frictionless systems. Shifting from daily willpower to automated habits is the most reliable way to maintain strength. Follow these systems and your financial life will keep growing, even when the economy around you changes.